Have you ever wondered how the ultra wealthy live off their portfolios, pay little in taxes, and still pass fortunes to their heirs? The playbook has 3 words: buy, borrow, die. Today I'll explain what it is, why it's legal, where the real risks are, and what regular investors can and cannot copy in that strategy. My name is Merrill Taylor. I run this channel here, Tax Tutor. This is an educational video, not individualized advice, so make sure that you talk with your tax pro before taking any action on what we discuss here today. All right, so buy, borrow, die. In one sentence is what it is you buy appreciating assets, you borrow against them instead of selling those assets, and when you die, your heirs receive a step up in basis that can erase the lifetime capital gains on those assets. There are 2 key mechanics that make this work. First, the tax code generally doesn't tax unrealized gains. If you owe capital gains tax when you sell, not while you hold. So if you buy a stock and it appreciates in gain, you don't pay any tax when it appreciates in gain. You only pay tax when you actually sell that stock. Second, the second reason why this works is that loan proceeds are not income because you have to pay those loan proceeds back. So you combine those 2, the no tax on appreciated assets and loans tax-free, and you can fund a lifestyle without selling stock and without having to recognize any income. So step 1 is you buy. So wealthy families will buy appreciating assets, stocks, real estate, sometimes art and collectibles, and then they'll hold those items for a long time to give them time to appreciate. So by not selling those assets, the gains remain unrealized and untaxed year to year. Real estate can add depreciation benefits. Equities may pay dividends. The point is to hold growth and avoid unnecessary sells. Step 2, you then borrow. So instead of selling those assets to get the money out of them and triggering capital gains, you borrow against those assets, such as portfolio lines of credit, securities-backed loans, or a home equity line of credit secured by a real estate. Those loan proceeds, when they come to you, are not taxable, but there are strings attached. There's interest that goes along with those loans, and so you got to factor in interest costs, and whether that interest is deductible depends on what the money is used for. Interest tied to personal spending is generally not deductible. Interest used to buy investments may be deductible as investment interest, and it's limited to your net investment income in that case. Now, business incomes, and there's lender risk. So if markets drop, you can face margin calls or collateral demands that force sells at the worst time. And there's lots of examples of that in history that you can look up, that people became highly leveraged in something, markets dropped, and they basically lost everything and became penniless. So there's no lack of risk in this strategy is basically what we're saying. But set up right might not be as much risk. It just depends on how risky it's set up. All right, and then the third step that we have here is to die. The $1 million, so at death, many assets get a step up in basis, meaning your heirs' starting basis becomes the fair market value at the date of your death. If they sell those assets right away at that value, there's little or no gain that will come from selling those assets. So lifetime appreciation over that, if you buy a home for $100,000, now it's worth $1 million. There would be $900,000 of gain if you sold that while you're alive. If you die, the home steps up to basis and your heirs can sell that and basically get $10 million with no tax in that. There's an important exception in this. Assets like a traditional IRA or a traditional 401k, certain annuities, are what's called income in respect of a decedent and do not get a step up. So the heirs will still pay income tax when those dollars come out of those accounts. Now, why is this strategy legal? Might sound illegal, might sound shady, but it's perfectly legal. And it's legal because it uses the core rules of the tax system. There's no tax on unrealized gains. Loans are not income unless forgiven, and inherited property generally gets a basis step up. Those are the 3 kind of key components of that. The combination is what people refer to when they talk about buy, borrow, die. So let's run some simple numbers. In addition to that other simple example I gave, let's imagine you have a $10 million in stock with $6 million of untaxed gain sitting in it. If you sell that stock to get the cash out of it, then you realize gains and pay capital gains tax before you can spend the money. If instead you borrow, say, $500,000 per year at, say, 5% against a portfolio, the loan proceeds are not considered income and the portfolio keeps compounding. The stocks and assets you own keep growing and appreciating in value, all subject to market risk, of course. Sometimes it goes down, sometimes it goes up, but over time you hope to see it go up. Now, when you die, your heirs inherit the stock with a stepped-up basis. They can sell some shares with little or no capital gain and use the proceeds to pay off the loans. Interest costs, estate taxes, and market moves change the outcome, but that's basically how it works. Now, the real-world kind of caveats, the warnings here, the dangers that you can run into. One, interest deductibility. If you borrow to invest, you may deduct investment interest up to your net investment income. But borrowing for lifestyle, say for personal expenses, vacations and things like that, is usually non-deductible. So you want to keep clear documentation of how the funds are used if you're deducting anything, say business or investment-wise. Another kind of issue is liquidity and collateral. So credit terms can change, rates can go up, and markets can fall. You want to build conservative loan-to-value limits and stress test for a 20 to 30% drawdown. 3, estate tax and administration. So step-up is an income tax rule. Very large estates may still owe estate tax and need liquidity to pay taxes or debts. And then 4, there's policy risk associated with this. Basis step-up has been debated for years. Plans with the current rules, you want to plan with the current rules that we have, that we do have basis step up, but be ready to pivot if the laws change. If those laws were to change, this would not be such a great benefit going forward because your heirs are going to pay tax regardless and then have a bunch of debts to pay off as well. Now, what can regular investors actually use? You don't need 9 figures to be thoughtful and go through this process. If you borrow, keep loan to value conservative and avoid using debt to inflate lifestyle. If you borrow to invest, document use of funds so investment interest can be traced. You want to know which assets get a step up and which don't, and make sure beneficiary designations and your estate plan are updated. If you're charitably inclined, donating highly appreciated assets during your life or leaving them to a charity at death can erase capital gains entirely. All right, so some quick frequently asked questions to run through here as we wrap up. Is buy, borrow, die illegal? No, it relies on standard tax rules. Could the law change? Yes, it can, so you want to visit your plan regularly. Can anyone do it? Well, it favors people with sizable, stable collateral and access to low-cost credit. Interest cost and risk can outweigh benefits for others, but you can kind of look at that and see if it makes sense in your case. Do heirs always avoid tax? No, they do not. There's assets like traditional IRAs that do not get a step up and are taxable to heirs when withdrawn. Is the loan interest deductible on the borrowing portion of this? Only in specific cases. Investment interest may be deductible up to net investment income. Personal interest generally is not deductible. All right, so what do you do next? You want to make a one-page map of your asset types, who inherits what, and your borrowing guardrails. If you're considering a portfolio line of credit, model the after-tax cost, track potential interest deductibility, and stress test the plan for a major market drop. And if this is helpful, please hit that like and subscribe button and share this with someone who really enjoys tax strategies, especially things along this nature, and we'll make sure to keep you updated with any changes in the tax law.